The world is endlessly curious about billionaires, and Warren Buffett is no different.
Warren Buffett.
Warren Buffett.
Warren Buffett. Warren Buffett.
Warren Buffett.
His name is synonymous with investing, and he's worth over $100 billion today. But despite his decades of success in purchasing and investing in individual companies like Apple, Coca-Cola, and American Express, that is not the investing advice that he gives normal people like you and me. I'm gonna get into that in a second, but there's something I need to do first. Since the 1960s, Warren Buffett has owned Berkshire Hathaway, which is a holding company. This means the only reason that that company exists is to own and oversee the operations of other companies. This is the letter that Warren Buffett wrote to his shareholders in 2013. Half of all coin flippers will win their first toss. None of those winners has an expectation of profit if he continues to play the game. Buffett has a long history of publicly calling out those who try to time the market. In 2008, he famously issued a challenge to the hedge fund industry.
If you're Warren Buffett, you can make million-dollar bets, and that's exactly what the Berkshire Hathaway CEO did back in 2007, placing a $1 million wager with asset manager Protege Partners that over 10 years, hedge funds would not outperform index funds. Basically, an amateur, low-cost, anybody-could-do-it investment would beat these expensive hedge funds. Now, by the end of this bet, Warren's hedge fund gained $850,000, while the actively managed portfolio only gained $220,000. Now there's some other points in this letter that I need you to see. It should be an enormous advantage for investors in stocks to have those wildly fluctuating valuations placed on their holdings, and for some investors, it is. Owners of stocks, however, too often let the irrational behavior of their fellow owners cause them to behave irrationally as well. Because there's so much chatter about the markets, the economy, interest rates, some investors believe it is important to listen to pundits, and worse yet, important to consider acting upon their comments. For these investors, liquidity is transformed from an unqualified benefit as it should be to a curse. Now the internet, the algorithm, whatever it is that you want to blame, loves talking about the now of the market. I think it's human nature for us to want to know an answer, why this is happening, when it's going to change, what's going to happen, things like that. But according to Warren, all that chatter shouldn't affect your investment strategy at all. You should actually buy more for cheaper. So before I tell you what we should be buying, here's the when. The main danger is that the timid or beginning investor will enter the market at a time of extreme exuberance and then become disillusioned when paper losses occur. I am all too familiar with this. I'm going on 3 years now as a finance content creator, and when the market is trending, swarms of people come in. First it was GameStop and AMC, and then crypto, and all these people threw their money in for the first time and then got a bad taste in their mouth and sold for a loss when things corrected. The antidote to that kind of mistiming is for an investor to accumulate shares over a long period and never sell when the news is bad or when stocks are well off their highs. So here's the part where he tells us what we should be buying. Most investors have not made the study of business prospects a priority in their lives. I have good news for these non-professionals. The typical investor doesn't need this skill. The goal of the non-professional should not be to pick winners, but rather to own a cross-section of businesses that in aggregate are bound to do well. A low-cost S&P 500 index will achieve this goal. He says he put his money where his mouth is, and in his will, the trustee information for his wife's benefit is to put 10% in short-term government bonds and 90% in a very low-cost S&P 500, specifically Vanguard. I want to put you inside my computer for a second to show you something. This is a website known as Portfolio Visualizer, so although I know past performance is not indicative of future returns, let's see how his advice would have performed. So I'm going to leave this from 1972 to 2023. We are going to do a fixed cash flow of $500 per month. So this is just saying that I started with an initial investment of $10,000. Every month I invested $500. We adjusted for inflation.
we contributed monthly, $500 per month, and we rebalanced annually. So now we know the US large cap, that's going to be our S&P 500, that's 90%. And then our equities short-term treasury is going to be the short-term government bonds, and that's 10%. So let's see. So we can see here that it actually adjusted the data to 1977 because they didn't have, it looks like, short-term treasury data for those earlier years. So we're now looking 1977 to 2023. Our max drawdown was 46.02%, which we can see occurred here between November 2007 and February 2009. Our best year was a gain of 34.9%. Our compounding annual growth rate was 16.44%.
So that means if you followed this advice, which is 90% low-cost index funds like the S&P 500 and 10% short-term government bonds, you would have a portfolio of $12.6 million. Now, the critic in me really wants to pick this apart, and I'm sure that there will be comments doing exactly that, saying there's no reason this would replicate, that was the best time in history, but if you just bought Amazon, if you just bought Bitcoin. But whatever way you dice it, this is very impressive. Now it's funny because this portfolio, just a few years ago when I was a bit more immersed in day trading and charts and technical analysis, just trying to find my way in this investing realm, I would have thought to myself, oh my God, what a horrible use of time. Who has the time to wait? I'm here to make cash, to trade stocks. If I'm not making money right now, I'm failing. But what I've come to realize is that as I get older and invest more passively and experiment with these strategies, I'm seeing the enormous value of these simple strategies. I'm not overstimulating myself or bombarding myself with trades. Now your mind will trick you with the dopamine that it gets from watching the chart and staying busy and whatnot. If you can stick with something over years and decades, you can see the potential. Having been on both sides, the super active and the super passive, being able to slow down, be very hands-off and broad with your investments, it sort of unlocks a level of clarity that you can't really get otherwise. It is so not the winter day in Phoenix that you would think it would be. Then again, it's Phoenix. What if successful investing looks nothing like the accelerated version that is boasted about online? I think being patient is a more powerful force for success than how many trades you take or how many candlestick patterns that you can memorize. And there's something really powerful about that to me. I started investing years ago with the idea of making money quickly. It's fun, I learn a lot, and if you've seen my other content, you know I actually really enjoy doing that. But that being said, I do think it's a mistake to leave all of your investments to this short-term strategy. Now, I've really loved learning about this, and to say that my investment strategy has changed over the last couple of years would be a massive understatement. Will I continue to trade options and invest in crypto and make content about it? Yes. But there's something so comfortable about a slow, long-term investing strategy that I think just can't be replaced. If you're interested in supporting my work, please consider liking this video,